So, Matthew, everyone starts their career somewhere. It's always interesting how people have their journey through life in different careers. How did you get your start in banking?
Similar to most bankers, I did not plan on coming into banking. I was doing metallurgy and welding and working at a credit union in Michigan while I was going through college. And then they offered to pay for my degree if I'd switch and go into business and finance. So I did my associates in metallurgy. I was doing mechanical engineering, dropped out mid semester to get a free education and went and finished my bachelor's in business and then just kind of went up through the ranks through every job from part-time teller all the way to my current role and just never really left.
That's an interesting journey. How long have you been doing stuff with SBA loans?
Since 2012, so did multiple different roles before that, but been strictly SBA since 2012.
Got it. So, for some business owners, they've done SBA loans before, and others they haven't. So, let's start with the baseline. What are the common misperceptions between a conventional loan, conventional business loan, and an SBA loan?
Yeah, this is a good topic. I actually, on my LinkedIn, have a campaign that I wrote called the Common Myths of SBA, and it walks through multiple of these. So, what people have to understand is an SBA loan is a commercial loan. It is just a subset of commercial lending. So, with the SBA 7A program, it works more similar to an insurance program than a lending program. The bank is the one lending you money, where people think I'm getting SBA loan, I'm getting money from the government. And that's not the case. You are getting money from a bank. The SBA is working like an insurance program behind the scenes to help reduce the amount of downside risk for the bank. And in turn, the borrower gets protection built through the SBA program. And the SBA, the guarantee from the SBA allows the lender to give terms they can't otherwise offer on conventional terms. So you're getting less equity down payment for SBA. You're getting no balloon payments on your loans, fully amortizing loan. There's no default interest rate allowed, things of that nature.
So the loan is still through the bank. The
Yep.
SBA simply, in essence, is an insurance policy in a way for the bank, and that enables the bank to lend more to various businesses. Okay, that's helpful. How hard is it to pull the information together that's typically needed for a loan?
Well, that's going to depend on what the request is for. So, the use of the loan proceeds, and more importantly, how organized you are as a business owner to start with. I have some business owners that can get everything the same day. Other ones, it takes so long they get frustrated and they give up. So if you have clean financials where you can get 3 years of financials and tax returns and fill out a debt schedule and have that information, quality information readily available, it can be as fast as you can operate. It shouldn't be that big of a deal, but sometimes if people are waiting on third party CPAs or bookkeepers and they don't handle like internal financial accounting, sometimes they're relying on third parties, which could slow it down a little bit.
Okay, that makes sense. So, in most major cities, there's an SBA office. They have various educational events. I've talked to various business owners, and they've always thought the place to start with an SBA loan is to go to the SBA office. That's not the case, correct? Or is it something different?
No, that's not the case. You know, the district office, they offer a lot of support to lenders. So like if we're trying to get something done and we're not getting the response we need from the SBA, we can go to our district office and they'll use contacts to help expedite the process and move the needle for us. The people that typically go directly to the SBA a lot of times I find are very either young business owners or startup business owners. They don't know where to go and that's where they go. And the district office will try to help facilitate introductions to different lenders, and they keep a running list that they update annually on what banks are doing what types of SBA loans. Um, but ultimately, they're probably not going to be the best place to go get advice. In the market, most SBA lenders know what they can do and what other lenders can do. And a really good place to start is the certified development companies. They're the nonprofits that facilitate the 504 program, but commercial lenders are their customers. That's who they market towards because lenders need that CDC in order to do a 504. So they know all of the SBA lenders and who can do what. And they're a good place if you don't already have a banking relationship to go get introductions.
So, if you have a banking relationship, whatever that bank might be, do you just walk in the door and talk to the loan officer about SBA, or do you do something different?
You can. I mean, if you have a good relationship with a commercial banker, part of that's going to depend on who you bank with. You know, if you're lending at one of the big institutions and you're with, a Chase, a Wells Fargo, your banker is not the person that does SBA. That is separate department, and it's kind of taken away from them, and it goes into a black hole. SBA, some kind of magic algorithm, pops back out. They don't have anything to do with it. At a little bit smaller, more community institution, your banker might have more of a role in the SBA, but typically you're going to get with someone who is specific for SBA within a bank. So, like I run our South region for Bell Bank. So, all of our bankers in Arizona, if they have anything that smells like a government guarantee, they're getting me involved. And then vice versa, relationships that I have, I'm structuring and kind of feeding to those bankers. But I solely do SBA day in, day out. So, you got to find that right contact person in order to kind of start the process. And most banks now have a website with an SBA like link to a department
Hmm.
where it gives you the information for the specific SBA contacts at that institution by region. And so that can be a good place to start as well.
Okay. So, from your perspective, what separates businesses that get approved for SBA financing versus those that don't? And even when their financials look good.
Well, if the financials look good and they're not getting approved, there's something else that's causing an issue. Most likely, they have some kind of prior default or loss to the government that automatically would make someone ineligible. So maybe it was a government-backed student loan, or they got an idle loan during COVID and it was on standby with no payments for 2 years. They moved business locations. They forgot the payments are supposed to start and they're not getting notifications. That's actually happening quite a lot right now. But aside from those anomalies, it's really the banks looking for kind of three forms of repayment. Cash flow from the business, number one. Secondary is like the liquidity of the owners, the guarantors, and their ability to step in to fix their own problem if something happens. And then
Okay.
the last is collateral. And we're really using a lot of times the SBA to overcome the lack of collateral. But
Hmm.
if two businesses side by side both have good cash flow, the only reason one would get approved and one isn't is if we have major credit derogatory marks, like on the personal side, or someone has way too much leverage, and the global cash flow, when you look at their personal household expenses, makes it towards this higher risk.
Okay. So, I heard this a couple times over the years that when somebody thinks, okay, I've gone through the SBA loan, I got turned down, I need to wait X amount of time. And it's like, really? I never heard of that one before. Is that a misperception? They got to wait X amount of time before they can
Yeah,
break through?
that's not accurate at all. And quite honestly, you could be applying with multiple banks at the same time. I wouldn't really recommend that. Now, if you're going to a few banks to try to gauge interest and get them your initial financial package, so you can understand that they have some faith, they've at least seen your financials before they give you a term sheet, that's fine. But once you get to the point of assigning a term sheet, you really should kind of pick one horse and stick with that bet. The market's busy. You know, if I had someone who's just, I've already done all of my work and they say they want to go with me, and then I find out that they're doing that with three other banks, I would just back out of the transaction because my time isn't worth that. We're busy enough with people that really want to do business. So that's one thing that someone could do that would
Hmm.
really hurt them. But if you were declined, to answer your question, you really need to understand, were you declined by the bank or were you declined due to SBA ineligibility?
Okay.
95% or more of the time, people are declined by the bank and they think they're declined by the SBA and they're not. And even a lot of SBA lenders portray it as though, oh, this isn't eligible for SBA. And that's not accurate. So the SBA is, they're taking these laws and then they're interpreting the laws to give us a standard operating procedure. And think of the standard operating procedure as the outer boundaries of like a sandbox. And they say, banks, you got to play inside this box.
Hmm.
Now, every bank has their own credit tolerance that's going to be smaller than the outer limit of what the SBA allows because the SBA is pretty aggressive. So an applicant might come to a bank, an example like to my bank, and we might not really like to lend to hotels. So I might say, sorry, I'm declining you. We don't have an appetite for hotels. But that doesn't have anything to do with the SBA. They could go to another bank who has an appetite for hotels and they're perfectly eligible. So understanding if it was based on the bank's credit tolerance for the decline or if there was truly something that causes it ineligible. A big one right now is that businesses must be 100% owned by a US citizen.
Hmm.
If there's any minority ownership that is not a US citizen, it's automatically ineligible. And if you have businesses owned by businesses, we have to pierce through those layers to get down to the individuals. So those are things that cause an issue. But no, you can absolutely, apply whenever you need to. If you get declined, you can go try again right away.
So just to pick up on that a little bit more, not all banks focus on all industries, right? So it's kind of
Correct.
in the courting process, it would be good for a borrower to understand the industries that are of interest and a focus to that bank, and so don't try to push a string, right? It doesn't go very far. If you've got to get into the right bank that's comfortable with your type of business, the size, the geography of it. So while your community bank might be a good source because they're close by and you know them, they might not be the right source for your business. Am I picking this up right?
Yeah, absolutely. As a bank, we're running a business, and the way that banks decide to run their business is different from bank to bank. Like we're regional. While I have the legal ability to lend in all 50 states, I need a business to be either located or have the owners located in one of our 3 states regions where we have a bank footprint. I'll follow my customers anywhere in the country, but I won't do just a one-off transaction in a state where I have no
Hmm.
bank presence. A lot of banks are like that. Other banks have a method where they're 100% national, and they'll even use brokers to facilitate the lending process. And then just the credit appetite and risk. We're privately owned and part ESOP, and our employees own are part of our bank. And so our tolerance for risk might be way different than like a non-bank SBA lender where they're owned by like an insurance company or something, and they're just trying to get assets on the book and turn money to get fee income. So it really depends on the business model of the bank.
So a potential borrower shopping, people want to shop by the rate, but it's really you're shopping the bank to make sure you've got a good fit and it fits into their portfolio and their areas of interest. Okay, that makes sense.
Absolutely.
So what about when people get turned down? I mean, just, they stop at that particular one or should they go to another one or, how many hits to the credit report? Walk us through that.
Yeah, so normally I would say it's not going to hit credit for at all the time you get declined. If you're working with a decent lender who's been doing this for any length of time, they can look at your financials, run a cash flow analysis, look at your personal financial statement, understand what type of support you offer as an owner, and give you a quick green, yellow, red light with a relatively high degree of confidence. If you're working with a younger banker or someone who's newer in their career, or maybe they just landed at a brand new bank, they're trying to feel that out. So they might be, a little bit ambitious saying, yeah, I think I can get this done, but it's because they haven't had a lot of exposure with the credit approvers to know exactly what they can and can't get done. So absolutely, if you get declined, I would say talk to that lender, especially if they're a specific SBA lender, and ask them, who else do you think might be able to get this done? There's a lot of times, like I get a loan opportunity, and I'm a firm believer in good news fast and bad news faster. So I'm quick to decline someone, but I will help them find the lender that can help them. And I want to be the pipes that the deals flow through. I'll get the ones that I can get done, but I'll help place them with someone else. And that's whoever referred them to me. It hopefully makes them look good that I'm at least adding value, even if I couldn't do the financing myself.
Okay, you guys are tight knit community, help each other out.
Very
Okay.
tight knit, small community.
Um, is a loan, or are there different types of SBA loans? So can you take us through that process?
Yeah, so there's going to be a handful of them. So I'm going to focus on the ones that are facilitated through banks. There's a couple like the EIDL facilitated for disaster directly through the SBA. But with the primary institutions like banks and non-bank lenders that you're going to see in the marketplace, there's really 3 different types of loans. The SBA 7A is the flagship program. That is what people think of when they think of SBA. Anything that we could do with a conventional loan, we can do with the SBA 7A program, with the exception of we can't lend to nonprofits, we can't lend for investment real estate, and like we can't lend to other lenders. There's a couple other rules, but in essence, Anything we can do conventionally, we can do. We can do real estate acquisition, equipment purchase, working capital term loans, working capital lines of credit, business acquisition, partner buyouts, partner buy-ins, even ESOP financing. It's really a broad program that is facilitated under the 7A program. And when you think of the 7A program, think of it as an umbrella with multiple different sub programs underneath of it. So I'm explaining all of the different types of use of an SBA loan. A lot of those are distinguished by separate sub programs under the 7A. But in essence, the 7A is just that insurance program. I'm using that term loosely. There's a
Okay.
fee charged to the borrower as a percentage of the loan. The bank sends that to the SBA the day that loan closes, and the borrower never has another fee. Every month, when they make their loan payment to the bank has a fee that we pay to the SBA. Our fee is variable and it cannot be passed down to the borrower. So, on every single SBA loan nationwide with every lender, they're all collecting that fee as part of the monthly payment. And one day a month, all of us lenders send the fee into that bank account. If a loan were to default, meaning they've already tried to work with the borrower, the bank is working with the borrower, it's not working out, and they're over 60 days past due, bank would liquidate whatever collateral they have, and then they can reach their hand into that bucket of money to get back a guarantee of up to 75%. And you mentioned misconceptions earlier, and that's a big one. People think 75% of the loan is guaranteed. While that's not inaccurate, it is misleading because the guarantee is actually 75% of the net losses after collateral's liquidation. So I'll have young borrowers come to me and say, well, you're taking collateral and you got 75% guarantee. There's no way you can lose money. And that's not how it works. It's after we liquidate collateral, if we're still losing money, we can get 75% of those losses back. So that's a 7A program used for anything and everything. The 504 program is used almost exclusively for commercial real estate. It can be for very
Hmm.
long term equipment, things that don't have wheels, like CNC machines and things like that. But normally, even then, is things that are affixed to commercial real estate. Without getting into too much complexity, benefits in the 504 program is you can get up to 90% financing without having additional collateral outside of the piece of real estate you're buying. And it's very long term financing at a fixed interest rate. Downside to that is it has a long prepayment penalty. But it's the best course of financing, even better than conventional in most cases, if it's a building that someone's going to hold for like 10 years. If you're buying a building, you're going to hold it for 10 years. Financially, when you look at the three different options side by side, you will choose a 504, just cheaper on fees, less equity injection, cheaper interest rates. Just a good program for that. And then the third program is the Community Advantage Program. And that is where a lot of lenders will refer business applicants if the loan is either too small, below what they're willing to do, or if it has too high of a risk tolerance. So the Community Advantage Program is part of the 7A program, but it's facilitated through nonprofit lenders like the Certified Development Companies. So the Certified Development Company is a nonprofit that underwrites bonds for the 504 program, but they have the Community Advantage program that goes up to 350,000. And since they're not a bank, they're not regulated the same as a bank, and their sole goal is to help create jobs. So they're going to be more aggressive than a bank. And they fill a very important role in the market of helping young businesses get up and get going. It's going to be a little bit more expensive than bank financing, much cheaper than equity or hard money lending. But their goal is to get your business going, help you get capital to grow. And once you have 2 years history, then you refinance with a bank and get out of that community advantage loan. And they're trying to turn the money just to really help those younger, smaller businesses.
Got it. It's, about, probably 2 weeks ago, one of our clients mentioned something about a 90% guarantee program, and I don't know if that was in some recent regulations or what was it? So what's the 90% guarantee program?
Yeah, so it's been around for as long as I've been doing SBA. It's the International Trade Loan, and it allows to get 90% guarantee if a company is exporting. And a common misconception is that people think of exporting of like I'm shipping overseas, and
Mhm.
that's not the case. It can be even indirect exporting. It could be you're manufacturing a part that goes into an engine for Boeing, and that Boeing jet's being sold overseas, and that counts. But
Wow.
what just recently changed actually hasn't been going into effect yet. So effective May 1st, here in just 15 days, what they did is they classified all businesses related to manufacturing and food service supply as automatically qualifying for the international trade. So the program's already been there. They just gave a blanket, hey, if you have this NAICS code on your tax return, you automatically qualify. So for manufacturers, that's NAICS code 31, 32, 33. The first two digits have to fall within that.
Uh-huh.
And then the big one is everything related to food. And they made it very broad. There is a laundry list of NAICS code. But if your business has anything to do with harvesting, growing, farming, whether it be plants, seeds, food, animals, chickens, ducks, anything like that, if you are growing, creating food, transporting or storing food, selling food in any way, you're pretty much going to be eligible, including like refrigerated trucking companies and things like that. And what the guarantee is doing is just that, is increasing it from 75 to 90%. So for the bank, that just allows the bank to take on a little bit more risk because there's even less of that downside risk if the loan were to go bad. And the goal is to make capital easier for those industries to get because they're already overcoming a hurdle with different competitions in the market and things related to wars and tariffs and everything else going on. So it's trying to help those businesses make sure that they can get capital.
And that's effective, May 1st.
May 1st.
Wow. Okay.
I've already got
Uh,
some in process. So
May 1st is right around the corner. Uh, you touched on the next question that comes to mind a little bit, a credit line. So I've heard people say, they tried to get a credit line, but they couldn't. But you can get SBA on a credit line, right? No problems with that?
you can. So well, that's a second question when you say that. No
Okay.
problems with that, Craig. So yeah, there's two different line of credit programs. There is the SBA Express line, which is anything 500,000 below. And then there's the SBA cap line, which is greater than 500,000 up to the maximum of 5 million. Mass majority of banks do not offer the cap line from, above 500,000 up to 5 million. At that point, you typically just go into a conventional line of credit where you're on a borrowing base. And a borrowing base means your monthly availability is tied to your outstanding accounts receivable and the quality of that. And that's how all commercial banks lend on nonprofits. Well, the cap line has those same requirements, but there's a lot of monthly reporting and a lot of work for the bank to facilitate that. So it's very, very rare to see a bank that'll offer the cap line. What is more prevalent is the express line. We do quite a bit of those. Most banks, if they're going to offer you any SBA line of credit or any line of credit at all for that matter, they're going to want the full banking relationship, including all of the deposits. That is the only reason they're doing it. Banks are losing money on lines of credit. We do not make money on lines of credit. So we're only doing that if we have a bigger relationship. We're really trying to help this company grow because we know that they're going to have more needs in the future and become a really good client. But the SBA Express line doesn't require monthly financial reporting, doesn't require any of that borrowing base. It's a 10-year loan approval, and then it's a revolving line of credit for 5 years. If there's any balance at the end of 5 years, it automatically terms out with principal and interest over the remaining 5 years of the loan. And by reducing the monthly reporting and the work involved for the bank, it makes it towards us much easier to facilitate that. We'll still only do it if there's a full banking relationship. And with that, a lot of SBA lenders will not offer any line of credit. And this is where it goes back to understanding who you're working with and what type of bank they are. The smaller national lenders, they only want term loans because when that loan funds, they're taking the guaranteed portion to sell on the secondary market to try to get fee income. So think of them more like a mortgage broker rather than a
Yeah.
bank. And there's even non-bank lenders. So they have a pile of money. They are doing SBA loans to you. They have the government guarantee. The guaranteed percentage of that loan, let's say it's 75%, when that loan closes, they can sell that to a third party investor and they'll get fee income for it. And now they're only holding 25% of that debt and they can lend more money and keep turning the money and they're making fee income. Lines of credit can't be sold. So it's going to tie up a balance sheet for a bank. They can't deploy those funds to do anything with them. If you're not utilizing the line of credit, they're not making any money on it. And they're just inherently a little bit higher risk. So there's going to be a few banks that will offer lines of credit, 500,000 below for SBA. Very rare to find SBA above 500,000 is typically when you're going conventional.
That goes to the point of you gotta find the right working relationship, not only by industry, but also by the type of loan.
Yes,
And okay,
and now that is a place where the district office can help because they send out a notice to all banks every year with like a Excel grid of what types of loans you're doing. Are you doing startups? Yes or no? Are you doing franchises? Will you lend to restaurants? Will you do lines of credit? And the banks tell the SBA district office what they will or won't do. And so that way the district office can kind of have a cheat card to say, hey, these are the banks I would go talk to that seem to be active doing this type of product.
that's where the SBA office can be of help. Okay, yeah,
Yep.
that makes got it. So, we work with a lot of business owners that are X amount of time from selling their business, right? It's gonna transition over to family, which they need financing for. They're gonna sell it to somebody else. They want to get, they want to make it more attractive, so they're doing things to get capital to grow that business. So, what are the common mistakes business owners make when they seek SBA financing and it's literally too late in their growth or their exit timeline?
Yeah. Now, I'm going to bifurcate this into two separate questions.
Okay.
When it comes to asking for financing too late, that is kind of separate from preparing to sell your business. A lot
Oh,
of times you're not seeking financing to sell your business. The person who's buying it seeking finance, and we'll talk about things you could do to clean up financials to get the highest multiple. When it comes to obtaining financing for your business, hopefully it's because of growth. Hopefully you're not getting debt because you're going down and losing money. If so, it's going to be very hard, almost impossible to do that. You know, banks are in the business of lending for growth and working capital and acquisition of assets, not to fund losses. But I'd say the number one thing that's a killer for businesses, if they wait too long, they get to a point of desperation, and then they'll go out and seek these merchant cash advance loans. You'll see if you Google like MCA loans, and these loans are what we call the spiral of death. It is extremely high interest rate. Borrowers don't even understand the interest rate. Their payments are getting pulled monthly or quarterly, or sorry, I should say weekly, directly out of like their merchant services account, right, or the bank account. So they're getting money pulled out before the borrower really even can do anything about it. It's extremely high, and they're not eligible to be refinanced into an SBA loan. So if someone goes to get one of those merchant cash loans as a short-term patch, thinking I'm then going to get an SBA loan to get rid of this expensive debt, they are stuck. They used to be able to do that, but with these merchant cash advance loans, it's technically not a loan. There's no note. There's not a promissory note. And that's the thing is if there's a promissory note, you can refinance it into SBA. These lenders aren't even having promissory notes. The way that it's structured is completely different. It's like a percentage of what you run with merchant cash. So that's the number one killer that I see for small businesses. And what I would say is, you need to be strategic and not, reactive when you're obtaining debt. You heard people say, the easiest time to get a loan is when you don't need it, and that's partially true. But be planning and have a relationship with your banker and talk to them about your goals. If your bank is a strictly reactionary, you might not be with the right bank. You should be meeting with them at least annually and saying, "Well, this is my goal, and this is what I'm doing, and I think I'm going to need this much in lending next year to buy these trucks or to expand whatever it is," and then make a plan and have a goal that you're actually working towards financially. And then the last thing, it may sound kind of obvious, but a lot of times it's not, is you can't play the tax game and the lending game at the same time. And that is the biggest misconception for people is they're like, well, if I run all my personal expenses to my business, it's pre-tax money. I'm getting 18 to 30% discount. And that's true. And a lot of times it's perfectly legitimate and legal. But we are underwriting to the cash flow of the business. And if you're expensing everything out of the business and you're not willing to show any profitability and cash flow, it's very hard for us to lend because we'd be taking on a lot of risk and we're just trusting you that you have all of these random expenses you put through there. And that's something that just doesn't work well. So keep your financials clean. And that ties into selling your company. It's one of the number one things is, if I'm looking at financing a business for someone and I see that all of the seller discretionary earnings and cash flow are based on ad backs, where I either have to try to document everything or just trust them,
Mm,
my willingness to lend on that is going down dramatically versus a company that's strictly based on net profit and like depreciation, amortization, seller's compensation, healthcare, things that are easily documented. You start running personal expenses and building a casita for your mom and running that expense to your business. It's hard to add those back.
Got it. Just curious, on the MCAs, are they do banks see, factoring very similar to MCAs?
It's a good point. So that is well under that same rule change. They are not eligible to be factored. I mean, they're not eligible to be refinanced into an SBA. So MCA and factoring, you cannot refinance into an SBA loan. That was actually put into the law last year. So prior to
Okay.
last year, you could, and it was
Right.
used as a facility to try to get out of those types of really high debt lending, if you will, or
Mhm.
quasi lending. And that is not allowed anymore. There was just too many defaults. Honestly, there's too many businesses that got that type of debt and they started deteriorating the balance sheet and the foundation of the business was deteriorating going down and then the SBA would come in and then it was too late and those businesses would fail and it started causing other losses so they kind of took that away.
Okay, that makes sense. So they've really gotta be bankable, without
Yeah.
the MCA,
Yeah.
without the factoring. Okay,
Yeah,
that
the
makes
SBA will get you into debt faster than or maybe earlier, I should say, than on a conventional loan. The bank's gonna be willing to
mhm,
get into that relationship earlier, but we're still looking at historical cash flow. Most
okay.
banks would probably want like a minimum of 1 year. I really like to see about 18 months minimum of cash flow available to support the loan that I'm giving them. Um, but it's rare to really lend onto projections. That's a pretty darn hard thing to do is to lend onto projections. With certain industries like medical and professional, like CPAs and attorneys, a lot of them can lend more into projections. But for most other industries, unless there is a future contract that's signed showing you have guaranteed future revenue, we're
Mhm.
really looking in the rearview mirror of what you did previously and not where you think you're going. Business owners are looking forward to the future. As lenders, we're looking at what have you already done? Prove it to me.
Makes sense.
Yeah.
So, SBA lenders, how are you guys evaluating the recurring revenue, customer concentration, cash flow durability in today's environment, which is a little bit different than it has been in the past? How are you guys looking at those?
Yeah, I mean, it's still pretty darn similar to what it always has been. The bank's, credit criteria isn't gonna change dramatically based on, the economies. We're one of the oldest industries in the world, and, we've kinda learned through the time what you can and can't do. So they're not gonna get more liberal just because it might be getting a little tough out there. We're really looking for, again, those 3 types of repayment from the cash flow of the business, guarantor support, and then collateral. Reoccurring revenue is great. If you're looking at like a contractor and you have one contractor who's only bidding new construction and their revenue is only as good as winning that next bid, and you have another contractor where, 40% of their revenue is on like maintenance contracts where they have
Mhm.
monthly subscriptions, boy, that shows a lot more resilience if we go into a recession or depression. So the bank is going to be lending more to that company who has reoccurring revenue rather than the company that's only lending based on future contracts. So that was one thing with the contract specifically. With customer concentrations, general rule of thumb is, 20% or more, we want to know about it.
Uh-huh.
Um, but that's where the business owner's ability to convey the risk and explain it really matters. As an example, I might have a business that shows that they have a 60% concentration with Discount Tire, as an example. But in the real world, each and every location of Discount Tire is ran as their own income statement by that general manager. And each store is ordering parts directly, even though I only get paid once a month from corporate Discount Tire. It looks like I have a giant concentration, but when you dig behind the numbers and understand the business, there's really less risk there. That's something that business owners really need to understand is if you have a concentration as truly just one business,
Uh-huh.
it doesn't mean you're not going to get financed. It means you need to be able to identify the risk and help the banker mitigate the risk. How long has that relationship been? How deep is that relationship? Have you gone through economic cycles where you continue to work with them? Um, Things of that nature. We just got to understand it and underwrite to it.
So it's not only the strength of the business where there's high concentration, it's really the cash flow durability and the strength of the concentrated customer as well.
Yep.
Okay, that
Yep.
makes sense.
Absolutely.
So how can business owners structure their company, typically 2 to 3 years in advance to become more bankable? So they're doing it not by accident or desperation, they're doing it by intention. So what can they do?
I mentioned a couple of them earlier. Number one, I would say is try to get personal expenses out of your business. You can be reasonable. You can have a car, you can have a cell phone, you can have your, own W-2 wages and your health care, things of that nature that are customary. But don't be paying your kids a wage when they're really up at NAU going to college and they're not part of the business. Don't be running your car hobby and have six sports cars that you're expensing through your business and running your hobby and your wife's horse addiction through your business. All of those type of things really make it hard for a lender. So that's number one, is get those out, have clean financials, have, again, clean accounting records, like actually have good accounting and stay up on top of
Mhm.
your accounting, and don't pull all of the money out of the business. Certain industries are kind of allowed to pull money out of the business. Like example would be like a doctor, because that company doesn't have future equipment expenses. The person is the job. So for those industries, yeah, they can pull a lot of their money out of the business. But for other companies, take a wage and take distributions that you need to have a good life, but don't pull everything out of the business to the point where you deteriorate the balance sheet. It's not just about cash flow, and it's not just about the income statement. And that's another misconception, is the balance sheet matters. And if we can see that you have some liquidity and you have accounts receivable and you have some good assets and equity in your balance sheet, that is what gives us kind of the understanding that you're going to be able to withstand a hiccup if something happens in the future. You're not living right to the bitter edge, which ties into the last thing of live below your means. Honestly, that's really it. When you're trying to grow, to the extent you can, live below your means, because then if you get that great opportunity and you have
Mhm.
a strong balance sheet and you've got liquidity, that's when you get to grow. And during times of recession is where a lot of people make the most money. That's when, if you have a strong company, you can go acquire competitors and buy equipment and buy things really inexpensive, when everyone else is freaking out. So yes, you got to celebrate when you're doing really well, but I'd say try to live a little below your means, so when opportunities arise, you have the ability to take advantage of them.
So it's really the opportunity for the business owner to see their business as an economic engine, right? And it has the opportunity to grow. It has the opportunity to be efficient, and where they intentionally treat it as an economic engine and make it healthy. That's one way to look at it, and it makes it bankable. Okay,
Hmm.
got it. So, Matthew, you see all different kinds of businesses, all different sizes, all different industries. If you were to give business owners, let's say one piece of advice, or maybe two if you want, um, their access to capital and the ultimate value, how to increase the ultimate value of the business, what would that advice be?
Well, access to capital is primarily going to come down to cash flow.
Okay.
And that's really what the number one thing the bank is looking for, is how much cash flow do we have? Because we know, and we're solving, I won't go into the math of it, but what the bank is underwriting to is we're trying to say, for every dollar of principal and interest you have to pay monthly in debt, the bare minimum that we want to see is that you have $1.20 after you've paid yourself and after you paid taxes. Now, that might be different for a couple banks. One bank might have a 1.25 ratio, saying they want to see $1.25. Another one might be lower. But on average, that is the general consensus of banks are underwriting to say, after you've paid yourself and you paid taxes, we want to see that you have this little cushion buffer. So that is the number one thing, is getting that up. So understanding the financials of your company and understanding the cash flow impacts is really important. Business owners don't run their business based on the financials. They're looking forward, and they're running their business based on the day to day, trying to get that next sale, trying to do this. But if you take time to understand your financials, it'll allow you to see trends over time. And it's kind of that whole adage of, if you got a guy in a hole, you don't want to give him a shovel. He's going to keep digging it further down. People think like, hey, I've got negative margins, I'm going to get out of it by doing more sales. No, there's a fundamental problem. You need to go back there. So you need to understand, or have a consultant, someone help you that understands the numbers and can tie your actions in daily life to the numbers, so you see the impact and you can show, when I'm doing this, this is what's actually happening behind the numbers. So really getting in and understanding the financials of your company would be one of the most important things, along with keeping clean financials. And that helps you not only get debt, but it also will help increase that multiple when you go to sell. I specialize in business acquisition and partner buyout financing. And that is one of the key things, is I don't want a large percentage of the cash flow all based on these subjective or discretionary ad backs. I want to see clean financials that I know are going to be sustainable and in the future. And then try not to have concentrations. When I say concentrations, it doesn't just mean with client. It could be that you, as the business owner, if you're also the number one salesperson, that decreases the value of your business because when you go away, the sales are going to go away. So, preparing to sell your business, try to start building in a layer of management is separating yourself from the business to show that it's sustainable without your daily input or direct oversight, and that'll help dramatically.
Yeah, most business owners, they don't go into business to focus on the finances, but they have to.
Yeah.
So that's where we bring in a fractional CFO, accounts receivable, connecting with folks like you. It just works so much better. Yeah, and they can still focus on the things that they do, but just having those other knowledge resources around them really makes a huge impact.
Yeah.
So,
Have a good banker that you can send your financials to
yeah.
and even teach you, like we'll share with them how we calculate cash flow and even give them a template and that way they can run it themselves at any time and kind of understand how the bank would look at them.
So I'm curious, how does it feel that you have the ability to empower people's lives and hopes and dreams with their business? You know, the blood, sweat, and tears that go into a business. How does that feel every day when you get to be right next to them, making it happen?
Well, that's a deep psychological question, but I'll tell you the first foremost thing for me is why I love being a lender is I get to look under the hood of every single business and see how they make money. And it is not what you'd think. Like there's some companies like a recycling company, huge operations, and they're losing money on everything except for the metal they recycle. They do all of the rest of it just to get the business for the metal, and that's where they make all their money. Other things like that, like you don't see from the outside, but when you really dig into the financials and you see the margins, it is very fun to see all the different types of industries and how creative people have been to find a business to make money. There are businesses you would never even think existed that do very, very well. That is the most fun for me. So that is, I'd say, the most rewarding for me. Now, there are times where you help a small business get a loan and it's doing something that's like dream fulfilling, like they're buying a business or you're helping them take their business to the next level and they're very appreciative and that feels amazing. It's surprisingly rare. I've been doing this 22 years. My wife is also an SBA lender. I can count on, one hand, the amount of times that someone has really came back to show appreciation to the bank. They're normally so focused on whatever it is they need the loan for that that is their focus. And as soon as they get it done, they're like, "Thanks, gone." So it's rare that someone is really appreciative, but on the rare occasion that happens, it feels amazing. But it is fun to help these businesses, and I've got, you know 10 or so business owners that I've helped over well over a decade. And they've even followed me bank to bank. And I have a personal relationship with these business owners where I know that I have impacted their life and their kids' life and helped make a difference. And that's really where you're trying to have those relationships and it's not transactional. You got to have a full relationship if you ever want to get to that. But those are fun.
It's part of that giving back to the community. So, Matthew, some point in time in your life, someone's given you some advice. Um, what would that piece of advice be that you remember, or what advice would you give to others? What it's that impact that we have on other people's lives. Or both of those.
Yeah, so a few things that I kind of live by, and I'll even repeat day to day. Number one is I would say discipline equals freedom. I don't remember where I heard that quote, but it's stuck with me. And I'm thinking of, the discipline financially. I'm sure it can translate into multiple other areas, but especially having financial discipline and being disciplined with your time and disciplined with the priorities that you're choosing to spend your time on allows you to have the freedom in the future. And I love that. One thing that I say to my borrowers every time when I'm talking to them is good news fast and bad news faster. The one thing neither of us can get back is time. So I don't want to be working with someone who's going to be wasting time, and I want to be respectful of time. And as a borrower, if you're talking with a lender, I would ask them to please be transparent and give them permission that if something's not looking right, to come back to you timely and talk to you. Because it is very, very hard for lenders to decline. I don't think borrowers realize that, but I can't tell you how many times, like, my wife and I have, like, been up at night thinking about it, stressed because we don't wanna let someone down. Lenders want to try to help you, and if the lender truly feels that they can get the financing done for you, and they've worked with you for a long period of time, and then something happens late in the process and they have to decline you, they feel about that big, and they absolutely hate it. So that is something, is give them permission to come back to you and say, "Hey, this doesn't look good. We're gonna have to work through this," because that's the only way that you can improve. And so giving them permission is really, really, really gonna help. And that was something early in my career I learned, when I was doing special assets, doing collections on loans. Nobody wants to talk to you when you're collecting on loans. Sales is easy compared to that. So, um, yep. So I'd say those are probably the two things that are really important, given the context of what we're talking about.
Got it. So, Matthew, as we wrap it up today, how do people get in contact with you? We can see you're with Bell Bank. Thanks for wearing the shirt
Yep.
today.
Yep. Yeah. And my LinkedIn is a great way. I've got my email and my phone number. My cell phone is on there. So you can reach out to me through text message or email. But a lot of people will just email directly. And that's the same with most lenders. A LinkedIn is a good place to go to get that information. And if something happens where a bank is acquired or things like that and emails change, pretty much always going to be up to date on LinkedIn.
Okay. Matthew, anything else for today?
No, not really anything. As I saw your dog behind you, and I have two miniature golden doodles of my own, so I was curious about it looks like a husky there, but other than that, nothing related to what we're talking about.
Yeah, the husky in the background, she was her 12-year-old husky, and she knew over 100 words.
Oh,
And,
serious?
she knew to stop and look both ways before she crossed the street, and if a car was coming, she would not move. But yeah, just, when a dog knows that many different words, you can't quite have a conversation, but talking huskies are known to talk anyway.
Oh,
So
yeah.
just, yeah, that was Kara, she's cool.
Oh, that's awesome.
It's good. Hey, Matthew, I really want to say thank you very much for your time today, your information, your knowledge. You and I have known each other for a while. I can see the passion that you have in helping people out and just making life happen. So thank you very much for joining us today. We appreciate it.
Absolutely. Thanks for having me.
All right, everyone. Thank you very much for listening today and catch us again on the next podcast with Enterprise Sage. Thank you.